All right, guys, lots of real estate news and economic data coming out both last week and some stuff coming up this week. So let's get right into it. So let's start first with mortgage interest rates, where last week we topped out at 8%, which was a number everybody was looking at. We basically made a 22-year high. Not since really the year 2000 or 2001 have we seen interest rates that high. This week, we're basically right at the same level, a touch below that. So home affordability still continues to be an issue for many buyers. That, coupled with the severe lack of supply, has kept home prices pretty high. So interesting to see how that's going to play out. As far as what is making those interest rates so high, there's a lot of drivers that affect mortgage interest rates. Obviously, the Fed funds rate that the Federal Reserve sets, that really affects short-term interest rates, but that tends to filter throughout the economy and also works its way into longer-term interest rates as cost of capital becomes more expensive. So the main factors that really affect mortgage interest rates, number one is inflation. When inflation's high, mortgage rates tend to rise. On top of that, economic policy, so the interest rates that the Fed sets, which are short-term interest rates, ultimately affects longer-term interest rates, which includes 30-year fixed-rate mortgages. So our rate's going to be coming down soon. That's what most people want to know. If you're an investor, if you're a homeowner, if you're looking to buy a home, or just an entrepreneur in general, it's really good to see, what do we think is going to be happening here with the housing market? And unfortunately, that brings us to this upcoming Wednesday, which is going to be the next Federal Reserve meeting. So throughout the year, the Federal Reserve will meet. They will announce what their target interest rate is, and they will set monetary policy such that they want to hit that target interest rate. Now, the rate they're setting is the Fed funds rate. That really affects mostly short-term interest rates, but what they've done since last year is take the interest rates from basically zero, and they're up at 5.25 now. Thankfully, this upcoming Wednesday, they're expected not to raise interest rates. What they've been doing by raising rates is really trying to slow the economy down. After COVID, we printed all this money, and that filtered its way throughout the economy, and as a result, what did we see? Rising prices. Anybody who's been to a grocery store in the last year knows that things are just incredibly much more expensive than they previously were. So because of all the inflation, the government was previously reporting inflation at a high of 7-8%. If you ask me, that's probably a bogus number. I think the actual real inflation rate was significantly higher, and they're trying to work it down to their target rate of 2%. Is 2% the right number? I mean, is that even, we just take that for granted. By raising interest rates, that is going to slow the economy down and bring that inflation down. And they've done that so far. They've brought it from what they're claiming was 7-8%. It's still somewhere in the mid threes. So they're not quite done yet, but they're probably going to pause this Wednesday. And the reason is they want to see if what they've done so far is, there's always a lag effect between when they actually raise the interest rates and then how we all feel it throughout the economy. And so because they rose interest rates so quickly and so aggressively, they're going to hit the brakes here, we think, and see just exactly how this all plays out. However, we could probably see more interest rate increases going into the next year. So I don't think we're out of the woods yet in terms of that. One final piece of news to talk about was last week we got our GDP numbers for the third quarter, and they came in really, really high. Now, what exactly is GDP and why is it important? Well, GDP is gross domestic product. It's basically the sum of all the goods and services produced in the economy. And so obviously a higher number means more economic activity, and that tends to be a better thing. You can't just look at the headline numbers. Just like when the jobs report comes out, just like when the GDP number comes out, just like when inflation comes out, you have to look a little bit deeper. And in this case, the GDP was 4.9%. What that means is the economy was 4.9% bigger than it was 1 year ago. On the surface, it sounds really good. But in actuality, the numbers are a little bit fugazi, and I'll tell you why. A far majority of that GDP growth was consumer spending. Consumer spending is up. Why? Because of inflation. Now, most people are going to say, well, they account for inflation when they come out with the GDP number. Well, that's true. But the Fed is claiming that inflation is only 3.5%. So we think inflation is actually much higher than that. So if inflation is higher than 3.5%, you're going to get a bogus GDP number. On top of that, the money being spent by consumers is going on credit. It's not even money that we have saved. Credit card debt just topped $1 trillion for the first time in history. It's the highest of all time, and it's still going up. So we're spending more money to buy the same amount of stuff with money we don't even have and putting it on credit cards. So, that's one part of GDP. The other part, I mean, there's obviously many factors that go into it, but another big component of it is government spending, and our government spending more than ever. I mean, we had a $2 trillion deficit, and there's not even a economic panic yet. That's normally something you would see when things were really, really bad, but that's just commonplace now. So we're counting all of that government spending in the GDP numbers, including all of those billions of dollars we're sending overseas. So we're printing money, taxing people for money, sending it overseas, and counting it as economic growth in America. So yes, 4.9%, the number that printed was very good. Probably not as good because inflation, I think, is higher than reported, because a lot of that money is government spending and because a lot of that money is consumer spending that's been put on credit cards. So with that said, I think that the next GDP number we get for fourth quarter is probably not even going to be that good, even with some of that, with the Fugazi numbers in there. So we have to keep an eye on that. But the big thing for next week, let's see what happens with the Fed meeting. Let's see if they do indeed pause rates or if they raise them. And if so, how is that going to affect real estate investors, homeowners, those looking to buy a home, entrepreneurs, or really just anybody who wants to know where the economy's headed and what's up next for us. So stay tuned for next week, and we'll talk to you then.